it'd be really tough to be a central banker anywhere in the world, right? We probably don't have to go into the detail, but, not just here in Australia, in the US, the UK, Europe, they're all, effectively got it wrong, right?
Yeah.
On the inflation read. But, you look at the data that comes out, and I'm living and breathing data, and on a weekly basis, there's just contradictory data all the time.
Cathro and Partners presents The Cut, a podcast about all things insolvency. Welcome to episode 7, season 2 of The Cut. Today's guest, very special guest, guy I know very well, in the industry for a while in terms of the credit reporting space, Mr. Patrick Coghlan, CEO of CreditorWatch. Patrick, welcome.
Thank you. Thank you for having me. It's a pleasure to be here.
As always, it's good to catch up with you.
Yeah,
we obviously see each other from time to time at different industry events, and everything that's happening in the credit space at the moment's definitely changing and has been changing for quite a while. But before we get into that, it's really good to actually have the time to sit down with you one-on-one, because generally we're, skirting between 10 different people at
That's
some
right.
sort of event.
Yeah, it's nice to be able to sit and chat.
Yeah, exactly. So I really wanted to just ask, how did you get to where you're at? How did you become CreditorWatch? How did you become the main man there?
Yeah.
Tell me a bit about yourself.
Yeah, it's a pretty good story, I think. I think, when you're in a business and you're obviously running your own business and you don't actually stop and reflect. So it's nice to do these sorts of things because it forces you to stop and think. I was working in a publishing business, a small publishing business, straight out of uni, doing sales, advertising sales. Worked there for a few years, resigned to go work for, a larger Google or Yahoo or, Fairfax or whatnot. That was the plan. And the owner of that said, "Hey, I've got this other idea. When you come back from traveling," I went away for 4 or 5 weeks.
Yep.
"Come and chat to me about this idea." So it was genuinely just a business, solving a business problem.
Yep.
Hadn't even been written on a, whiteboard or anything. So I came back and we had a chat about, what's a debtor and what's a creditor and what is credit, because that was foreign to me. I was in sales. I didn't, necessarily classic, salesperson doesn't worry about how the money gets collected. And and we started to whiteboard, and so that was 13 years ago this month, actually.
Yep.
And that became CreditorWatch. So I've still got the initial whiteboard pictures or doodles that we put up.
That you put together to
here
get
we
to
are,
that point.
13 years later.
It's amazing. It's I speak to people a lot on these types of things, and what I'm noticing coming through, it's a lot of kind of people falling into stuff.
Yeah.
It's not really planned. There's no, oh, hey, I was going to be, the biggest and best and president of the US or whatever it might be. It's literally, I was doing something, I got to a fork in the road and an opportunity came up and I started going down that path and here I am. And it's really interesting that happens to most people and particularly people that become successful in whatever they end up choosing to do.
Yeah, and look, I'm not really a planner. And if my wife, listens or watches this, she'll be laughing. But the one time I did have a plan around going to work for, a larger organisation, then try to go overseas and do it. I ended up starting a small credit reporting business.
That's now a behemoth.
It's now quite big.
Yeah, it's, look, I did something similar when I was trying to figure out what I wanted to do too. Went overseas and travelled and did all sorts of weird and wonderful stuff. And opportunities just came up. And
it's good to, I'm glad I did it. There's no regrets. I think if you've got that opportunity to start something, on your own or start something new or join something new, it's bloody tough, as you would know, But if you get it right, it's unbelievably rewarding.
So tell me about like the first 6 months, year, 2 years. Like, was there any doors that didn't open? Was there lots that shut? Like, how did you go about that?
Yeah, look, we had this, we had an idea that, we'd create a solution for small businesses to ensure they got paid, right? It wasn't a debt collection business, but effectively the problem that the founder had was that he had advertisers that wouldn't pay their bills, and then he'd see them advertise in a competitor's magazine or website, and he'd call the publisher or the owner of that business and go, "Hey, did so-and-so ever pay you?" Nah. didn't pay me either.
Yeah, right.
And I was like, there's got to be a better way to do this, right? The accountants, the lawyers, the debt collectors say, especially under $20,000, as you would know.
Why would you bother?
Write it off, move on, cost of business.
Yeah.
And it didn't feel right. So that was effectively the light bulb moment to go, let's sort that out. So we thought we'd create a subscription offering that would provide a credit report, which we probably didn't even call it a credit report back then because none of us came from the industry. Some debt collection tools that a small business owner could use, and we'd charge a monthly fee, and we'd get word of mouth and PR and digital marketing, and we'd never wear a suit again, as I sit here in a suit. We'd never have to do face-to-face pitches to sales, from a sales perspective. And of course, it didn't work out like that at all. Within a couple of months, we were putting suits on and going out and seeing clients. And it was interesting, it really did start in the small business world, but quite quickly larger organisations, and I'll shout out the AICM, that's been a huge part of our business, were contacting us and going, well, look, we want to use your product, but I don't have a corporate card. I'm not going to sign up with a credit card. You've got to send me an invoice. So look, some of the challenges, funny ones like invoicing at the end of the month, we had a folding machine. We'd put all the invoices. This is before Xero, right?
Yeah.
So I think Xero's probably a similar age. We probably hadn't quite adopted it just then.
Yeah.
We were folding all of these with a folding machine, posting them out.
Wow.
Right.
Old
so it was like real old school. And then you'd get a piece of paper that would get jammed in the folder, and you go.
It takes me back to my days when I used to stay up till midnight at the office printing out reports and having to stuff them into envelopes.
Totally. So that was some of the funny stuff, and it was obviously challenging. And I don't have a great historical memory looking back. I'm more of a just get on with it and move forward. But there was plenty of luck. We got support from ASIC to get. Become an ASIC information broker, which obviously allowed us to sell company searches, company extracts to show shareholders and directors and whatnot. And that formed a big part of our credit report. It also formed a big part of being able to alert people to changes. So there was some luck along the way that certainly played a part as well.
I think you do need a bit of luck, but you make your own luck too by banging on the right doors and speaking to the right people. So it's it's definitely, even in my journey now, we've been going for 2 years just this past week.
Yeah, congrats on that.
Yeah, thanks. It's it's gone really, really quickly. And like you, I'm kind of a looking forward kind of person as well. And I actually haven't really had time to reflect on it myself. But there was lots of sleepless nights for me thinking about, okay, I'm going to do this. I've got a big mortgage. I'm just about to get married. Like, where does this?
Why am I doing this?
Well, I was lucky enough to have started my own business previously, so I kind of had a little bit of insight from that side of things. But it's a little bit different when you've got commitments and you're in a position.
As you get older, more commitments. Yep.
That's right, and you want to be. You're confident that you'll make it work, but at the same time, it is going into the unknown and then having to put in all the work to set it up and the constant growth and change that you seem to be experiencing all the time. We're still experiencing it.
Yeah, and the best laid plans often.
Oh, absolutely, yeah. It doesn't matter.
Within a couple of months.
Well, we've literally moved within our own space like 3 times in the last 12 months simply because we've been outgrowing it. And look, it's all of those challenges are great, and you start to build the right team around you, which I'm sure you have,
so
given
important.
where you've got to, and then that obviously just continues to flow in itself. But it's definitely it feels good thinking about it now and thinking back and going, okay, well, I had some sleepless nights, and my wife probably got sick of hearing me complain about this, that, and the other. But it's definitely rewarding to get to this point.
Certainly is.
Yeah, so, look, I mean, so you've got that, you've got ASIC, you're at a point now where you're starting to get some momentum.
Yeah.
Are you 10 employees at this point, 20 employees?
Yeah, we're probably, so the first 2 years, I don't think we're probably 5.
Yep.
And then we were fortunate to raise some capital, which was really, really great for the business. And they were just a great partner to support us through that growth as well. Sure. They were believers. They gave us cash. We were sort of short on cash and didn't demand equity in return.
Yep.
And then we were very sales-led rather than product-led. Build the product and then go get customers. We were very much go get customers, sell vaporware, come back to the office. The CTO would look at us and go, "What have you sold this time?" And we said, "Okay, you got to build this." So he'd do that overnight.
Yeah, right.
And we would just naturally target larger and larger organisations, right, over the years. And as we got, sort of cash flow positive, we'd go hire some more salespeople. And then, for every probably 3 or 4 salespeople, we get another developer.
Yeah.
And it was somewhat rinse and repeat for that middle ground.
Yep.
But we spent a lot of time obviously focused on the product itself because that was always going to be the reason we were able to sort of differentiate ourselves in market.
Yeah, and sustain yourself and grow too, right? There's a lot of, like you mentioned, a lot of tech businesses that kind of start with the product and then go down the sales route or rely on that organic growth. And unless you've got a fairly deep pocket and a 4, 5, 6 year runway to get to a point where you're at scale and you're becoming cash flow positive, and we all know that's particularly tough nowadays. You're in a world of hurt. So it's pretty interesting that you went out there, sold the dream, and then built it straight away.
That's right. Yeah. So there were a lot of sweaty moments where we felt we've really got to deliver this now. And when you were dealing with smaller businesses in those early years, they were probably more forgiving than what larger businesses would be.
Sure.
But we got a huge amount of support from those larger businesses as we started to get bigger, and we were a real alternative in the market, which was great. And I think along the way, you touched on people earlier and building a team. That's always been priority number one for me, for us, is to get, the right people who are really capable but have a real focus on culture. And we've got just fantastic tenure from a lot of long-standing employees. Yeah. And then the good thing about that is that they then share that culture and act in that way that they got when they first came on board for the new people as well. And so I was telling you earlier, we just had our end of financial year party, and I don't know, it feels like 50% of the company's new, right? And they're all meeting one another for the first time, plus interacting with, some of the execs like me who've been there for, 10, 12, 13 years. And just really good people, a lot of fun. And, we're competitive, we're hungry, we want to win. But we want to do right by, one another and the customer as well. Yeah,
it's fascinating. Culture's a real focus for us at the moment too. I had a look at your website before we started today, and I see your health and wellness initiatives.
Big.
It's a big part of it. You've got your coffee stuff and your massage stuff and everything else that's attached to that. And we're doing something similar at the moment too with our team, and it's really, really important to foster that and be able to live it as well as speak about it, right? And that's the challenge as leaders in our businesses, for us to continue to do that. And obviously getting to where you are now and with the people you have on board, it's a credit to you that you've been able to do that anyway. So it's something that we're pretty focused on too.
And I think a lot of leaders talk about it but then don't actually put it into action as well. And it's not easy to do, especially as you get bigger, because you start to get diluted from that, as the new people come on board. And they look to the existing staff to understand how to act and
how to approach it. And if you've, like you said, if you've built that culture and that's then feeding into itself as you get
you're spending
bigger.
So much time with these people. I mean, we've mandated 3 days, sometimes 4 days a week in the office. So, but even pre-COVID, obviously 5 days. So you're spending a lot of time. You want to get along with people.
Absolutely.
Right?
I mean,
you want people who can perform, but you want to be able to get along with them.
You're awake more time with them than you are with your family for the most part. And it's like a second family at the end of the day. It's particularly important to keep that front of mind.
I'd like to think that resonates through the industry to customers as well. And you and I obviously see one another at events all the time, but I think we've built quite a good cultural brand in the market as well. So there's that shared sort of customer success and employee success.
Yeah, absolutely.
Which I'm quite proud of. That gets mentioned a lot.
Yeah, and you should be. And I mean, your products have obviously evolved over time too. So you can see that in the reporting that I see.
Yeah.
It's really interesting and great that you've been able to maintain that while you've grown too.
Innovation's incredibly important, and we're lucky that being newer, even though it's 13 years, we've got that flexibility with the technology, and our engineers and product team are just some of the best in Australia. I genuinely mean that. We're quite a unique technology company, growing, profitable, cash in the bank, et cetera, et cetera.
Happy days.
It's a good place to be, and we get rewarded with, fantastic people who produce great products.
And you've got to invest in them too, right?
Yeah.
And obviously that, again, is another piece of your culture. We have a structure where our guys get rewarded if we hit our performance targets, and we're actually paying our bonuses out this week, funnily enough. But I think that all kind of breeds that cultural piece, as well as being cognizant as ourselves as leaders of making sure we live those values as well. And like you said, sometimes it's difficult when you're growing and there's 50 different things to think about. But you just got to bring yourself back to it at some point and say, well, hang on, this is why we got into business. This is what we're trying to achieve. And this is how we need to go about it. So you, 2, 3, 4 years in now, you're at what, 50 people, 100 people?
No, probably less. Still probably, I'd say maybe 20 to 30. So we didn't raise money and just go out and sort of hire, dozens of people. We were still quite focused on nice, sustainable growth. But as we got to sort of year 5 to 7, the machine was purring, right? We were winning a lot of clients. We were winning some really big companies that, are mainstays. They've got billboards. They're, top 100, top 200, ASX or private, largest private companies in Australia. So we knew we were onto something.
Too,
there was credibility, and it's a virtuous cycle there. And we had our sort of sales structure right. We knew, all of our metrics that the reps needed to hit. So we were maturing as a business as well, but still had that, fast startup, innovative, mentality that came with the product development. And we took on some more capital from a company called Infotrack, which you're probably familiar with.
That's who I get your reports through.
There you go, yeah. So they operate sort of parallel to us as a search provider. So that allowed us to grow a little bit further, a little bit more, get some more people. So we probably hit the 50 mark, I'd say, around year 7. And then they actually acquired us in that was 2017. So that was sort of towards the end of year 7.
Yes.
And that was sort of then a new journey for us.
Absolutely.
But every sort of 3 or 4 years, it's a new role and a new company really in those early years.
Oh, absolutely. And it's like we've got alliances with a firm out of London at the moment. We do some stuff with a firm in Perth that kind of supplements the headcount that we have. And we've got Brisbane, Canberra, about to open Melbourne. So we're kind of on that.
And they're the challenges, right? Like you have these, some pivotal moments within a business where you open an interstate office. We had one person in Melbourne, so trying to make them feel part of the company.
Yeah, that's another challenge.
It's a real challenge. And then, one person in Brisbane, like how do you manage that? And then
we're up to 4 there now. We're about to go 5. So
there's all little things that you can do reading on, but unless you've been through it, you're kind of just acting on instinct more than anything.
Yeah. And that, again, culturally, that feeds into it as well.
Yeah, exactly.
We started with one in Brisbane, Declan, and he's done really well. He's got to a point where he's registered now and trustee and a liquidator, and he's built his own little team off the back of that.
Yeah, great.
Going from strength to strength. But we invested the time, and he came down for events with the team down here, and we spent some time up there, and that all kind of feeds into it as well.
Yeah, definitely.
So it's crazy when you get to a point where 13 years in, you've been through that journey. You're now obviously very well placed in the market. You get opportunities to be a commentator on different things. You do your business risk stuff every month, and that kind of leads me into, I guess, the next part. You've got to this level now. You've got your great customer base. You're growing your team out. And now, in terms of the product that you have and the insights that you've got from the research and the inputs that go into it, what are you seeing now in the market, and what have you been seeing kind of pre-COVID, COVID, and now post-COVID?
Yeah, good question. So just to paint the picture, our software collects data, and then we obviously sell data. We're basically a software and a data business,
sure.
But we operate in the credit reporting space, and we get a huge amount of data in that gives us the ability to go, oh, why aren't we reporting on this from a PR media perspective, right? Yep. Which our business risk index on a monthly basis. So we had planned to introduce that sort of late 2019, and then 2020 hit, and COVID hit, and it was like everyone wanted access to data. And I'm certainly on the record for saying there was going to be a tsunami of insolvencies, and there was going to be a horde of zombie businesses, right?
Well, it's the crystal ball, right?
Your whole industry was like, what happened?
Yeah.
Right. So we now put together this monthly business risk index that shows how businesses are paying, how industries are paying, how regions are rated from a credit rating perspective.
Yep.
So we can rank the best region in Australia all the way down to the worst, broken up to about 300 odd.
Yep.
So we weren't doing that pre-COVID, but it was a perfect time to actually launch it because everyone wanted to know what was going on.
Sure.
I always talk about the sort of three most reported on stats, over the last sort of 3 years was obviously, COVID cases.
Yep.
Vaccine numbers and insolvencies, and now it's we're probably still third, but behind inflation and interest rates.
That's
right?
true.
So we've positioned ourselves really well to be able to report on that. And what we've seen, particularly through COVID, was the effect that lockdowns had on cities and states and businesses. While there weren't the same number of insolvencies, obviously through that call it 2021. You could still see, a real effect on how businesses could actually meet their financial requirements and pay bills.
Yeah.
And then as we've come out of that, there was, a natural uplift, and it was very positive. And then this inflation wave has caught up and slowed a lot of businesses down. And I think through it, what I've learned is it's really easy to generalize. It's really easy to say there's going to be
that or the other.
A lot of insolvencies. There's going to be, it's going to be tough for businesses because inflation's high and interest rates. But you've actually got to look into industry specific or geography specific or both.
Yep.
And that's the real key takeaway from me, that, we know that, certain industries are doing it really tough, like hospitality, right?
Yep.
That's probably our number one highest risk industry, and regularly a top 5, I would say, historically.
Yeah.
But by far and away, they're sort of about 50% higher probability of default than number 2. So they're really doing it tough. But I mean, I just had lunch in the CBD, and we're in Sydney CBD now. You walk around and you can't get a booking at a restaurant, right?
It's amazing. There's so much activity happening.
And especially Tuesday, Wednesday, Thursday.
Well, that's right.
Thursday's the new Friday.
So. It's that change in cultural piece.
That's it. But then, you take a step out a little bit and you can see there's a lot of for lease signs or, businesses that just haven't opened back up. And so I think what's really important is to dive into the data and understand it from a more granular perspective.
Absolutely. Even I was out presenting at the CAFPA conference, which is around commercial property, and I did some statistics just on the construction space, and as it's been well publicised,
overly publicised
probably. There's a lot of things that have been happening in that space, and just looking at the statistics like you, I overlaid a map of Australia for 22 and 23 to see where the appointment postcodes in that particular space were. And it was interesting to look at how in 22, most of that stuff was centred around the cities.
Yeah.
And into 23, it's now expanded regionally, particularly in Victoria and New South Wales, and more so in WA as well. So it's just getting into that level and figuring out, well, hang on, yeah, it was city-based previously, and now we're out at a point where it's affecting the regions. Where do we go next? And what does that look like going forward? And that's the whole tsunami of insolvency.
Yeah, it's just delayed, right?
Yeah,
you know,
it's not. It's hard, and I've given up trying to predict things because the crystal ball just doesn't seem to work, right?
Yeah.
But if you look at trends over time, and you look at 2008, 2009, right? Shock then.
Yeah.
3 years later, insolvency practitioners super busy. So it takes that kind of time to work through the system. And COVID's a separate shock altogether. Like, I suspect that there will be a gradual increase and continue to be, but when does that peak and when does that taper off? Is it is it the standard 3 years like previous, or is it a longer tail? And that's really something that obviously would be borne out in the fullness of time.
Yeah, that's it. And I think, it'd be really tough to be a central banker anywhere in the world, right? We probably don't have to go into the detail, but, not just here in Australia, in the US, the UK, Europe, they're all, effectively got it wrong, right?
Yeah.
On the inflation read. But, you look at the data that comes out, and I'm living and breathing data, and on a weekly basis, there's just contradictory data all the time. It's changing. It's changing often. So making the prediction is tough. We know insolvencies are back to where they were pre-COVID. So they've obviously gone up quite quickly, but really back to where we were.
Yeah.
Some industries are doing worse. Others are doing better.
Yep.
We expect it to continue to climb, of course. Probably, anywhere from 10 to 20% above pre-COVID, 5-year sort of averages.
Yep.
However, the asterisk caveat is that, if there's no more rate rises and we get confidence from the RBA that they're possibly done or probably done.
Or close to done, at least.
Yeah, I think that's sort of horizon one. That's that first level of certainty that business owners and managers and lenders and whatnot are looking for, is when are we done with rises? And then number two will be, when are we going to see reductions in the cash rate? So that will change the level of the number of insolvencies significantly, because there's, at the end of the day, you need insolvencies to happen, right? And it provides better businesses with a better chance of succeeding because they get access to better people and better funding and better customers.
Sure.
And I think that'll play out over the next 12 months as well.
Yeah.
There's also a lot of businesses out there that are sitting on investment. They're not hiring.
Yeah.
They're not accessing more capital, buying more assets, etc., because they're in this sort of wait and see, almost a tread water style.
Yeah, that uncertainty piece.
Yeah, exactly. And once they have that, we're at full employment.
Yeah.
We've got a really robust financial system.
Immigration's back to levels that it used to be.
Yeah, we're manufacturing on shore now.
There's lots of positive stuff, and that's again, it feeds into, well, what happens from here?
Yeah.
I'm not going to get my crystal ball out, as I said, but it's interesting in terms of the data piece, and just thinking about this a bit more. Obviously, you guys do some of the default stuff for the ATO now as well, and the reporting on that side of things is starting to be ramp up gradually. Is it?
Yeah.
So where are we sitting from that side?
Yeah. So the way I sort of talk about it is that the ATO have really transformed their collection practices. And they've modernised it to what good quality credit reporting teams would have. Sorry, good quality credit teams would have at large banks and big trade credit providers.
Sure.
So there's that, and they've also not they had sort of 2 years where they didn't collect.
Yeah.
So which we saw, I think it's a doubling of outstanding debt. So they made a lot of noise at the beginning of this year around notices that they were sending out. Everyone's on notice. You're going to get this. This is what you have to do. But they hadn't started collecting, and then they made it clear that now we're going to start collecting, and now we're going to lodge default. So it's a real slow and steady approach, and I get that. You can't take the politicisation out of that process. They can't be seen to be hammering small businesses, even though they're the ones that are not paying their bills. And as a taxpayer, you want everyone to pay your tax bills. So it has been a slow ramp up.
Yeah.
I think the most important thing is that they can do it now. We don't want to lose. We don't want to lose the opportunity for the ATO to register those tax defaults, right?
Yeah.
So let's get it right. All the parties involved.
Yes.
And now, just recently, they've already started to speak about an additional ramp up in the number of defaults. So I think they're talking about sort of 2,500 this year.
Yes.
I don't know what the number is that, they if they could turn them all on tomorrow, it's probably tens of thousands. So it's they get how important it is.
Yeah.
As a creditor, you want to know if your debtor, if your customer has a huge tax bill, right?
Yeah.
If they do, you don't want to expose yourself to it, or you want to mitigate your risk.
Exactly. It's going to change your decision as a credit provider, as a credit manager in a large organisation as to whether you extend it or if you taper it or you take different security. Like all of those things come into that conversation when it's known.
Yeah.
And we actually, at the ACF meeting, we had one of the senior debt people from the ATO speaking about their approach to debt collection and the practices and what's been happening. And I'm not going to jump into DPNs and things because I'm sure there's enough people who have heard about it on these kind of podcasts previously, but they actually have, to be fair to them, have smartened up in the way that they approach it.
And they're using data as well themselves, really data-driven approach to it.
And they've kind of got to weigh both sides of the coin up too. It's not just hey, I'm a credit manager with 10,000 customers and I'm just going to have at it for all of them that are late because I've been supporting them for the last 3 years. It's the country, and it's a bigger hurdle to jump in terms of making sure you dot your I's and cross your T's, right? So, look, it's just par for advancing and trying to be better at that whilst managing the economic consequences that flow from it, right?
Yeah. And more money is being collected, which is great.
Yes.
Right? That's ultimately what needs to happen.
That's
people
right.
have to pay their bills. Like insolvencies have to happen, you have to pay bills. So that's only good for, budget.
Yeah, exactly. It's it's all interesting stuff, and being on the coalface and seeing the data all the time for you and me, obviously seeing the after effects of it. It's all interesting from my point of view as to how that's going to continue to flow through. Yeah. And is it 2, 3, 4, 5 years? Is it longer than that? I don't know, and I can't really kind of stick my finger in the air and go, here's the wind, it's going that way. So it's interesting times, definitely, and not from the way that I thought it would be. Yeah,
exactly. It's changed. I mean, go back to late 21 and we were all in lockdown, and 22 was sort of booming, and then late 22 was like, It
kind of feels like it almost wasn't a thing, right? Like we slept for a year and a half, and then that was that.
And we were back to it.
It's good. It's all good stuff, and everyone's learning along the way, which is the main thing too. Yeah. So in terms of where CreditorWatch is going now, where do you see it going in the next couple of years? What do you think is going to come out of that?
We just did our first sort of formal 3-year planning.
Right. Strategic
planning, which was a great process to go through. We got some external consultants to help, people who've been in the industry. Yep. And we've got this really, really clear picture of what we want to achieve, and ultimately that's sort of remaining really loyal to our core offering, which is, help you onboard clients, help you assess clients, and help you collect from clients, all automated with software and unique data. Right? Not being distracted by anything outside of that, which is good because we want to be the best at what we're already good at and continue to grow. That there's a real growth focus there for us. We know that there's a huge market out there of customers for us to approach, and there's a huge number of existing customers that we've already got that we want to continue to deliver more product for. So it's nice to have that really laser focus for the foreseeable future. Stay in Australia. That was always a question: do we go overseas? Do we not? With think that there's plenty of market here for us to focus on, which is good because that brings its own challenges. It's difficult to manage someone in Melbourne. It's really difficult to manage someone in the UK.
Oh, absolutely, so. And different jurisdictions, different hurdles to jump legally, all of that stuff.
Yeah,
definitely comes into play.
More of the same, just better.
Yeah, nice. Oh, look, it's been a pleasure chatting to you today, and the only other thing that I probably wanted to ask, over and above talking about CreditorWatch stuff, what do you do in your spare time?
So I am a part-time cyclist. But I've actually just engaged with a triathlon coach to help put a bit more structure into my week and stop taking shortcuts in my training. So,
it's the hard part.
Yeah. So maybe a triathlon or two in the future.
Yeah, good. My wife's got me running the City to Surf on the weekend.
Nice.
But we're Barry's Boot Camp fanatics. So
good.
Good old 6 o'clock in the morning, start that. And I find it just helps with my day in terms of being ready to go too. I'm quite focused. I'm awake. I'm not needing 3 cups of coffee to get going.
Great for mental health. Great for energy. If it's been a few days since I've exercised, my wife's generally the first person that tells me to get outside, go to the gym, jump on your bike, whatever it is. You're bugging everyone in the house. Piss off and go do some exercise and come back.
Fair enough.
So I love it. I love being active.
Yeah, it's a good way to be, and obviously busy in life, busy in work, all those types of things, and the mental health benefits come from that as well. Yeah,
definitely.
So, Pat, thanks so much for making the time. It's, as I said, really good to chat to you outside of walking past 10 other people at an event, and really pleasing to hear how you're going with CreditorWatch, and long may it continue.
Thank you. It's a pleasure to be here. I really appreciate it. So look forward to catching up again at the next event.
Sounds good. Take care.
Cheers.
Thanks for tuning in to Cathro & Partners The Cut. We hope you've enjoyed today's episode. For more insights, please visit our website, cathropartners.com.au, or find us on LinkedIn.